So I think the leverage that'll come from that gains, while the majors will do well, it finally came time for me to say, hey, listen, it's time to even look at the most riskiest, the most uh, where failure is the norm, I like to say, in the junior market, the pure company that just goes out to try to find that initial deposit and so forth, we like to call expiration stocks, because they're now needed more than ever, and they're the only group. Now, I didn't look at all 517 groups that make up the S&P 500, but I looked across the board. It's the only group where I see across the board they're all still undervalued.
What are some of the characteristics that you see coming that the general person, the general investor, the everyday man and woman on the street should be paying attention to, that's going to be a direct result of this BRICS coalescence, against the US dollar?
So I made that decision at the end of 2021, Gary. I foresaw, I was hearing it. I said, and one of the greatest benefits was going to be gold, that I actually said that gold would outperform the stock and bond market, and to actually own it versus the general stock and bond market. And it did. It's given triple the return, and bonds actually lost money during that period of time. I don't think it's as cheap or as attractive as it might have been when it was hundreds of dollars lower, but I think it was an indication of where it's going. I think the other thing that people have not recognized is that what we talked about, that the government is getting into such a dire need that it's not going to be able to provide the services that all our families and past families have grown accustomed to. And therefore, one day they're going to look around and expect something to be and just not be good roads, good infrastructure, all that type of stuff. But here's the real description, if I may. If you and I were meeting 20 years ago, 30 years ago, sometime in that time frame, and I was having lunch with you, say, Gary, did you hear about that country? What? You go, yeah, the guy that was once president, who while he was president, they tried to impeach him twice. And then as soon as he was leaving, they claimed he tried to cause a revolution. Then they brought up all sorts of charges with him in different places and different causes. They even found him guilty on one of them. And by the way, he almost was killed by a sniper. And the guy he's running against or was running against, he was kind of brought in on questionable theories of whether he won or not. But while he was there, his family was accused of all sorts of misappropriation and bad things. And then he got elected by his own group to be the representative. And then suddenly he was yanked out. This is what you would have said to me then, Gary. What South American third world country are you talking about? And that sounds like a banana republic. Well, it's the United States now.
It sounds like a Tom Cruise movie, to be honest with you.
Well, but think about it, Gary. That's the reality of it and all. So people ask about what to be concerned about. What more do you need?
Amazing. So, Peter, in the current macro, geopolitical, economic, and market environment that we find ourselves in, what should real tangible assets mean to investors everywhere, and why should they be paying close attention to this sector?
So I have a general thesis. I enacted it in myself. I had to lose 7 figures, not once, but twice, to get myself to finally do it for my own self. And it's become a way of life for me, Gary, not counting how I tie my faith into my business, but less is more. Debt is the dirtiest 4-letter word in America. It's not a curse word. Debt is. And because of how we've gotten involved into levels of debt, not just on the federal level, but the state and local level, corporate debt, consumer debt, less is more. We need to learn to live with less. I think that's very, very important. The second thing is that we are still more invested than we realize. And why I say this to people is a lot of people may not be watching the stock market each day, but indirectly it's quite dependent for them. Even if they're not into 401ks or still some of the old pensions and all, the companies they're working for are very dependent on the stock market performance. And therefore, if it turns down, their ability to hold on to their job may be in question. I think you have to become more self-sufficient. And one of the things about tangible assets, now I'm not into art. I don't believe in collector's items. I want to know something that can be used, and I don't have to worry about, a wide swing in its valuation. That's one of the troubles I have with cryptocurrencies. It's a high risk technology stock. If you want to treat it like that, that's fine. And that goes back to gold. That's why gold has just worked and worked higher and higher as things more troublesome becomes. The problem now at 2,500 is this. If you tell me in the next 2 years or even three that gold is $5,000 or more, Gary, you somehow saw the future, man, the world we think is bad as now had to get a lot worse. And therefore, if you are going to bet on it going up a lot higher, be prepared that a lot of things that you're used to being around to may not be as good or as enjoyable as it once was.
Well, from the first 30 minutes of our discussion, it sounds like you're not expecting things to get any better. In fact, you're expecting things to get worse, to degrade further from here.
Yeah, I've called this past spring, I told our clients it's time to actually build a financial arc, to do some of the things you and I just discussed, become more dependent on ourselves. Less is more. If you're into debt, try to pay it down. Become less dependent on the government in the future. Don't count on government services, and including some of the things people are going to expect from government, Medicare, Social Security, things of that nature. And like I like to say is, I hope I'm wrong. And if I end up wrong, it didn't hurt you to be that much more. But if I'm right, most people aren't moving in that direction. And therefore, I think, building that arc, I am certain, and I'm not saying I'm godly like, I don't want to compare myself to Noah, but I got to believe when Noah was first building that boat, it must have been 80 degrees and sunny, and they were yelling up, "Hey, idiot, what are you building that thing for?"
Exactly.
That's kind of what I've heard in these last few months, but we'll see in a year or two if that was correct or not.
Well, I think you've been vindicated to a degree, but from what I hear you saying, it's vital for everyone to have gold in their portfolio as a monetary hedge.
It's funny about that. You say that. I've been saying for years, and I tell this often, but it's worth repeating. Whenever we sit with our planning group people and I have a chance to talk to them, I'll say to them, listen, there is one thing I'd like you to buy, but I hope it doesn't go up. And they said, what's that? I said, gold. And they kind of look at each other. It's usually the husband. And the husband goes, Mr. Grandich, why would you want us to buy something that isn't going to go up? And I said, well, chances are if it goes up, what you own a lot here is going to go down. And you have car insurance, you have home insurance. Now I'm trying to get you some financial asset insurance. I think minimally always you have to have an alternative insurance policy to what still most people own a lot of financial assets. And that's why gold has always been an insurance policy. In recent times, for me, it became a capital gains opportunity place. But I also think that if you are carrying credit card debt and you're paying 18 to 20%, that in itself is the investment to pay it off. Where you're going to make 18 or 20% in the stock market, yet you will, to pay these things. So there's a lot more than the simplistic things, but still 7 out of 10 families I see still come in living one or two financial levels above their income. They're still borrowing. They still got a bunch of car loans or car leases sitting in the driveway. They're not contributing to their retirement plan because they're using that money to live a lifestyle now. And all those things are going to be paid for down the road. And unfortunately, for many of us, that end of the road is here now.
Habits are hard to break, Peter. so those are hard habits to break, and they'll be broken when the economy breaks. But the end of every inflationary cycle includes really a generational distrust in paper, like you've been talking about, and a brief parabolic flight to gold. I mean, let's be honest, gold always wins in the end at the end of these cycles. In your analysis, is technical activity across the board indicating that we're approaching that period now for this cycle?
Well, I think for the first time, the gold interest is appearing to the investment community. There are, just in these recent days, from people I haven't heard from in a long time saying, hey, I just heard on the news gold's 20. When did they do that? I don't even remember being over 2,000 because they don't pay attention to it at all. But remember, where gold has been rising is where people have been buying it, and that's in Asia. Not just the Chinese, but Asia in general. And they have really bought a lot of it. They're one of the key parts of it. And therefore, if you ask me as an American or a Canadian, North American, yeah, the average is behind the eight ball. They have not, to this day, they still don't have exposure. I always like to say, everybody, the Bank of International Settlements, the central banker's banker, so to speak, as some people like to call him, not only made bonds a tier one asset, they made gold a tier one asset a few years ago. Everybody that we come in, almost all of them have some sort of bond exposure, but almost none of them have any gold exposure, even to this day. And yet the banker's banker rates that as the same level. And I try to point that out to people. But then what happens is, Gary, they go and listen to mainstream financial media. They hear from a mainstream financial advisor, and they tell them gold. Gold to this day is still treated like kryptonite by the financial service industry. And yet, even since the new millennium, that here's an interesting statistic. I know I'm singing to the choir here, but I think people who ever see this should know this. Gold has now outperformed the bond market over the last 50 years. And
Amazing.
The bond market was considered in the greatest, biggest bull market for 40 years until a couple of years ago. And now gold has even outperformed that. And yet most people don't even have any real ownership of it. It's an amazing phenomenon.
Like I said, gold always seems to win in the end, right? So you were bullish on gold for several years, and you called for 2,500 gold several years ago. Here we are. We're over 2,500. Well done. Now that gold is over 2,500, and we're seeing what's taking place with the BRICS and de-dollarization and the move towards settling their trade in gold, which is going to put a floor under gold and also under the demand for gold. What are you projecting for gold moving forward?
Well, I haven't said this yet. You'll be the first person I'm saying to, so you have an exclusive. I did write about it this weekend because people were asking, okay, Grandich, you said 2,500, now we're here. What's next? In this industry, you're learning that you're only as good as your last call, and your last call is only as good about for a minute, and then people want something else. I think it'll be very hard to see the gold price below a number 2 starting in the front, and it's 4 digits. There would have to be I don't even know what it would take to do that now. Because you made 2 very good points there, by the way, Gary. I commend you for that. One, when people realize what has happened and where gold is going to be used in this new world, some sort of acid-based backed unit, it's being called, that these countries are going to use, and how recognizable much of the world where growth is happening, people are buying gold as an investment. It'd be very difficult to see it down more than 20% from this price. So I think your risk is $500 if that's, you want to use round numbers. I do think we're going to get to 3,000 in this move. We're going to get something close to that. There's going to be enough things happening over the coming months. But Gary, I start to have double wishes. In one instance, I don't mind if it goes to 5 because I'll make personally a lot of money if it does. But really, Gary, if we have a $5,000 gold price, and then just the next few years, things got a lot worse, and they're already bad now. So I don't know if I actually want to see that to say, hey, I was right, just because now a couple of billion people are getting so hurt from that.
Is that what you're...
It's not my fault. It's not my fault. But in some sense, I'm willing to give up some of that excess joy if it means a bunch of people won't be hurt as bad as they will be. But I tell you this, if you took my kid, even though she's 32 now, she'll always be my little girl, I would risk saying that gold will be worth as much, if not more, than a stock or a bond will be, a general equity, over the next few years.
So you're saying a 1-to-1?
Yeah, I'll tell you this. What I have done, and this is important, I know you cover it as well, is I've now decided that the companies that produce it, sell it, and then also look for it, now can actually go up more as gold goes up than gold itself. So for me, and this is just for me, and some people like to hear what I'm thinking, I have switched to the mining exploration side of the gold equation. But I think minimally owning physical gold is always a mandatory part of a portfolio.
So that's a really good segue into this next question, Peter. With the higher gold prices and the revenues that are flowing into the mining companies, what are you expecting for the mining equities moving forward? And where do you see the biggest gains in the metals and mining sector to be realized?
Well, the producers are going to have a much better Christmas this year than they've had the last few years because their expenses have peaked and have come down, and gold's up hundreds of dollars more an ounce. And unlike other industries, there's not a lot of big change in cost. Okay, it's kind of fixed. You need oil for machinery, you need this. But basically, if that stays within the same price, but the price of gold goes up that much more, almost all that gain flows to the bottom line. And therefore, free cash flow among the producers is, when we listen, they've doubled since March. The majors, the Barracks, the Agnew Eagles, the Newmonts, okay? And they'll double again if we go to 3,000. I mean, that's just the profitability and all is going to be. But what's interesting to this equation is, especially when you get past gold and you go into base metals, we've had such a lack of real meaningful exploration for almost 15 years now that on one hand, this don't worry, be happy crowd on Wall Street will talk about EV and AI and all this beautiful stuff and everything. And all of that needs certain metals that we're seeing less and less above ground supply, harder to get to, and more difficult to work in the places where we normally used to find it. So I think the leverage that'll come from that gains, while the majors will do well, it finally came time for me to say, hey, listen, it's time to even look at the most riskiest, the most where failure is the norm, I like to say, in the junior market, the pure company that just goes out to try to find that initial deposit and so forth, we like to call exploration stocks, because they're now needed more than ever, and they're the only group. Now, I didn't look at all 517 groups that make up the S&P 500, but I looked across the board. It's the only group where I see across the board they're all still undervalued.
Do you see a setup for another M&A cycle to take place in the sector?
It's happening already, Gary. We've seen it now. We've had 2 or 3 major deals in recent weeks, and a real key one was with BHP and Lundin Mining.
Yeah,
they're willing to spend a few $1 billion on a project that's still years away. That's going to need a lot of money till it produces. There's already been acquisitions of cash flow. I mean, taking over other producers that were already producing. That was good enough. But to see that type of deal is a signal to me, and I think others, that there is a real big need coming, and there is going to be a big movement in that. And understand this, for 2 years, I've been horribly wrong about in my own portfolio from the junior segment part of it is, but they are just wholesale, almost at a point throwing a dot type of thing. Now, what I will tell people is don't try to suddenly become an expert overnight in it. And that's why an exchange traded fund or a GDXJ or something like that that gives you broad representation would be a better choice for somebody that's not focusing on this as I do.
So silver has this dual benefit of being both wealth preserving as well as an industrial use value asset. And while silver has served as historical currency, its superior conductive properties right now, they're needed for the global energy transformation, the AI, everything you talked about, the electrification, in order to create more efficient power. Silver's been running ever larger deficits annually for the last 4 years. I think a third of it, of all silver produced, is by silver mines directly. The rest is a byproduct. Gold is moving, as we've talked about throughout this discussion, and the gold to silver ratio is expanding instead of contracting as expected. It's done this reversal. In your analysis, is silver gearing up for some massive catch-up gains?
So I used to get in trouble because I used to speak at conferences and say you have to own 3 to 4 times as much gold as silver, because silver is like kissing your sister. And boy, I couldn't even make it to the back of the end of the room without getting hit by the silver bugs.
That's funny.
In most recent times, Gary, I think silver has become more attractive. I believe it deserves more attention than I used to give it, to the point where I wouldn't be against if somebody said I have an equal proportion of gold and silver. I have no problem with that. I think, and I depend on others for this, and one or two people who've been in forefront speaking about this. There's been some recent attention brought to the fact that what China may be doing with silver now is what it did a few years ago with gold, and is quietly, aggressively accumulating, going out to countries, buying the silver directly from the mines, et cetera, et cetera. And by the time we do learn of that, it'll be up a lot. I'll say this much, and this will at least, maybe I'll get a Christmas card from the Silver Bugs because I said this. I do think it's going to make up for that lost time, that spread. And that's when we'll know we're in the final and biggest stage, when silver moves and the junior resource mining stocks are moving and all. And those of us who bought much lower and all, we can't get caught up in that. We got to learn to take some profits in those things, something I haven't done in the past. But I do think it warrants that attention now, and will make up for lost time. Now, I've never believed it should be ahead of gold, but I think it should be in the same seeding area as gold, not just on the same side of the field, but basically sitting near it. And I, I don't follow it enough to say silver producer directly. You're right. There's not as many of those. Most of it does come from byproduct. But I think also, and this is just a side note, if you don't mind, where a company looks now in the world is critical. I limited myself to North America, except for one company that's in Ireland. Look what just came out of news out of Mexico, which was known for a place where if you said to me silver mining, I would have said to you, Colorado, someplace like that, Idaho, and then in Mexico. Now they're talking about a mining law change there where they might even just basically get away with above ground mining, or cost, arm and a leg. But I do think silver is going to become attentional once people realize how important gold has come in the brick situation. So it may still be a few more months where it lags and it drags and you can't understand it. But if you and I are alive and blessed to be talking a year from now, I think silver will have made up some of that spread that you speak of.
So you brought up a few times in this discussion about the underinvestment that's been made over the last decade plus in real tangible assets, in the efforts to go after them, the mining. Peter, energy has been extremely underinvested. Some are saying as much as $3 trillion over the last decade or so. Uranium is part of that. It responded last year. It broke out of this consolidation from under $30 and it went all the way to over $100. It's been consolidating again for more than 5 months or so in the low $80 range. But we all know that about the supply and demand story. It's real, it's historic, and it is still intact. What does your analysis point to for uranium, and do you like it as an investment moving forward?
So I got a couple of really people I like a lot that are really involved in uranium. That's all they speak. Live it, breathe it, love it. And I love them. They're good people. And I know they weren't thrilled because this past January, I actually got out of it. But remember, I was looking at uranium when it was under 20, and stocks like Cameco were in single digits. You're right. If all the metals you look at on paper, they have the best supply demand scenario. Ever increasing power needs, usage of other ways of getting falling by the wayside. We're now seeing these windmills that they put out in the ocean are collapsing, and all the solar places, bad weather comes, they get destroyed. Yet people going, why isn't the price going up so much and all? And that's the frustration. The problem I've had, and problem's not the right way, the struggle that I have with it at this point is, unlike any other metal, Gary, there's only a handful of producers. So I have three choices now. There are a few companies that buy the physical uranium and store it, and hopefully it goes up if the price goes up. There's a handful of public producers in good places in the world that I don't mind owning. And then the rest are exploring wannabes. And just like in juniors, 7 out of 10 aren't going to be successful no matter what the price is. Now, everybody assumed, and I understand why they assumed, that uranium was going to go to 150 or 200 on that move. All these things were going to be lifted. Now I think the wiser people that are staying in that market are weeding out these. I invested in a junior. It's horrible. Poor choices by the management, things that they said was going to happen didn't, so forth and so on. I think you have to be more selective if you're going to be in uranium. And I think you have to be overweighted with producers and the people that own it, and then underweighted in the juniors.
Well, this has been an incredible conversation, Peter. And before we wrap up here and I ask you the final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct, just like this one, they're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote, and it's based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed this conversation with Peter as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. It's now time for our Golden Nugget segment, Peter. Let's discuss portfolio positioning based on everything that we've discussed today and with your experience and your worldview as your backdrop. How are you positioning for the next 12 months? What assets do you like, and what assets do you absolutely want to stay away from?
So, as I declared this weekend when I updated my goal view, I'm a riverboat gambler. I'm not a utility person and I want to make 3% and cut coupons or anything of that nature. So, I've always been a speculator and always been more of a contrarian. So, if there's a big crowd there, I'm kind of heading. And probably somebody said something good this weekend is, Peter, if you're notoriously bad in one thing, this is a friend that told me, you're far too early when you get involved with something. But I answered him by saying, well, you know what I learned in this business in 40 years, Gary? It's better to be far too early than a day too late. So, yeah, I was early in the junior segment of metals. I think that'll be made up for here. This is what I think people should be focused on, Gary. I think this is the best way. This is what I tell for people that come to us for planning. Capital preservation now overweights capital appreciation, meaning markets were easier years ago. It was. So you could gamble and try to turn a dollar into three, four, or five. I don't think you have that same type of fair opportunity anymore. So kind of preserve first of what you have, identify a certain amount that you can put at risk. And then if you can, the metals and mining, you brought up a thing that probably this time next year we'll have to be talking more about is oil prices again and things with the energy. But I really think getting your household in order, budgeting to know what you have, what you need, and become very self sufficient as much as possible, recognizing that you're just not going to be able to count on the government to assist you in any major or major minor way in the coming years. And pray to God, God has an influence on this election. I won't say who I'm voting for, but I am believing that there's two dynamic, different ways we could go depending on who wins the presidential election. Not that if the one that I would like to see wins cures everything, but I think it slows down the deterioration where the other person will just accelerate the bad stuff.
Is there an asset that you are staying away from that you just don't want to touch right now, or is that not an issue for you?
Yeah, I think the dollar.
The dollar.
I shouldn't say that. Bitcoin. I call it Bitcoin. Okay, Gary. That's how negative I am, and that will, even if people don't watch this are gold oriented, it'll find its way to the cult. It is an absolute cult. You cannot begin or even try to have a conversation with anybody that's behind it. And when anything gets that way, if it was that way on gold right now, where if I talk to you and said, gold's the greatest thing in the world, then I know I have to go against it. So I would probably say cryptocurrency, Bitcoin first, and then the dollar. I wouldn't want to be long the dollar. Not that it's going to go down a lot because it's really just among a bunch of sick currencies. But I do think gold is not going to double in price again in the next 3 years. I hope not, because like I said earlier, it's going to be troublesome if it does. but I do think things related to it, especially the companies that produce it and explore for it, is there now day in the sun.
Well, Peter, thank you so much for coming on to Metals and Miners and for being so generous with your time, your analysis, and your ideas. It's been incredible to spend the time with you. Would you please share with the viewers, if you have an overall theme that you want to leave with those tuning in, where they can learn more about your work and how they can connect with you?
Well, most of my work, Gary, is done on, got to call it X, still right to say Twitter, X/Twitter. There is a blog, there is a YouTube channel. And I think being I was one of your first
You were my first interview.
Man, have you come a long way. Not that you were terrible then, but you have come. I mean, I only pray that you have the same gain of success from our first interview to our second, that if a God willing, there's a third. Great job, Gary. I get all your stuff. I read every article you send out, and thank you for having me. I really appreciate it.
Well, I appreciate it. I'm going to put all the information about your website and your Twitter, your X handle, and everything else. It'll all be there. I've been following Peter since before I had him come on the first episode, which I believe by memory is January 29th of this year. So if you want to go back and watch that, that was our very first inaugural episode. But I will put all that information up there. If you're not following Peter at this point, you need to. He's almost 5 decades in terms of Wall Street experience. He shares a lot. He's humorous. He's self-deprecating. He is a man of faith. He's got a lot that he shares. I just really think you need to go follow him. I look forward to having you back on, Peter. Thank you for being here with us. And everybody else, thank you for watching.
Praise be to God. Thank you very much, Gary. God bless.
I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct, just like this one, they're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote, and it's based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us.